Please pay close attention. The next 30 seconds could make up for all your stock market losses this year and even save your retirement. You'll have a rare chance to hear from two Wall Street legends, Mark Shakin and Joel Littman. What Mark and Joel are going to share with you could make or break your retirement. A way to 5x your money even if the market crashes another 20% this year. And they say what's coming before the end of the year will create and destroy fortunes depending on which side you're on. Let's face it, the stock market's been a minefield this year with the biggest sell-off we've seen in 50 years. And thanks to inflation, even cash isn't safe anymore. Your money is losing value even as we speak at a rate we haven't seen since the 1980s. They'll be giving you a financial lifeline that could erase this year's losses for you and trigger a wave of potential wealth that's so powerful it could save your retirement. For a sneak peek of Mark and Joel's big reveal, go to perfectstock2022.com. Again, that's perfectstock2022.com. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here on Stansberry Research. Well, we all know the storyline by now. The Fed is going bigger, longer, and bolder than expected. But what does this all mean? How should we be preparing? Joining me today is Chris Versace, Chief Investment Officer over at Tematica Research. Chris, always good to see you. I was going to say he's back, fresh from Milan Fashion Week.
No, sadly no. Just back from the state of Virginia, I'm afraid.
Well, that's glamorous enough for us. Chris, break it down for us. You know, we had that ugly sell-off last week. I want to talk to you about that. I want to talk about the Fed. Let's start with the Fed, given the latest rhetoric we're hearing from them. What's next?
Well, coming out of last week, I think the playbook is going to be, as you alluded to, going bigger for longer. We take a look at what Powell had to say following the 75 basis point rate hike. We take a look at the updated economic forecast that they shared, and it's pretty clear that in order to get to that 4.4% funds rate exiting 2024, there's going to be another 50, another 75 basis points that we have to go, both at the November meeting and perhaps the December meeting. In my opinion, it's going to keep us and pretty much everyone else watching the inflation data, not just for a slight increase, but really looking to see, wow, as commodities come down, as gas prices have rolled over, are we starting to see a more pronounced move lower in the inflation data? And if we don't, I think the Fed is going to say, look, we need to keep going. And that's partly why you see that 4.6% forecast for 2023. But remember, these are forecasts. And the Fed's never forecasted a recession. I would argue that they're not the best forecasters, so it's relying on us to continue to chew through the data as it comes through.
It's interesting. I was reading a report that Wharton's Jeremy Siegel was actually saying the Fed, especially Powell, needs to apologize for their missteps. Is that an accurate assessment, would you say, Chris? Were they missteps on the Fed's part?
I think it's hard because remember, this is not, a snapshot in time. There's a lot that has been going on really since the beginning of the pandemic. And as much as we would like to think that things were, quote, over, last year, well, what happened as we came into 2022? We had the war and those implications. Obviously, I'm referring to Russia and Ukraine. We had renewed lockdowns in China, not once, not twice, but 3 times. We have also had some other developments on the supply chain, out in Los Angeles and that port there, as well as the port of Long Beach, a potential trucker strike, potential rail strike. There's been a lot going on, and I won't call it a black swan or a perfect swan, but I would say that it makes it for an extremely challenging environment. And it's always easy to play Monday morning quarterback and, someone should have done this, they should have done that. And the Fed's always an easy target. So I would not be overly critical of the Fed. Again, because, think what I just said, sorry, that, they're trying the best that they can based on the way they see the data as it unfolds.
I could just see the comment section now. They're going to say Chris Versace is defending the Fed?
No, I'm not defending the Fed. I think that, had they gone bigger earlier in the year, perhaps, inflation might have started to cool sooner. But make no mistake, the Fed is driving the market. The old adage, don't fight the Fed. This is where we are. This is the reality that we need to deal with.
Absolutely. But let me ask you this, because a lot of people are saying, okay, the rates are being, are rising, but we're not seeing inflation cool down. Now, obviously, it's not going to happen overnight. It's not going to happen with, 3 rate hike cycles. Based on your experience, Chris, how long does it usually take to creep it to the system and really start fighting inflation? How many rate hikes?
Well, that's kind of a two-pronged question, right? Because we know that there is a 6 to 8 month lag in monetary policy really rippling through the economy. So, as we stack more rate hikes on, then that headwind that emerges for the overall economy becomes greater. So it's really a balancing act, a tightrope, if you will, that the Fed has to walk. In terms of numbers, that's a very, very hard thing to pinpoint. And I'll say that I think that there's going to be a few more. I think that we'll kind of see the Fed adjust its policy, being mindful that they don't want to overly damage the economy. I think what that means is we could go from 75 basis point hikes to perhaps a couple of 50 or a couple of 25 as it kind of seeks to land the craft, if you will. Having said that, though, the impact of the economy is going to be something we're going to have to watch. We're already seeing the housing market roll over. There will be others, but remember, the Fed said that there will be some pain. They're taking this out of the Volcker playbook. They want inflation back to something far more manageable.
And so in this environment where it just feels like everything is melting, where are you seeking shelter? Is it just the US dollar right now, 2-year Treasury?
Well, no, I mean, that is a fair point about the market, because with the 2-year hovering around 4.29, 4.3, it really has removed what people have called, the TINA market. Idea being that there is, nothing else or no other alternative for people to go to. So there is some of that. But I think in terms of stocks, if you've got to be exposed, we're looking for more domestically focused companies that really removes any kind of, dollar or currency issue. We're looking for more defensive names, more inelastic names, meaning, products and services that people will buy no matter what is going on, in the economy. And we also like names that are poised to benefit from spending out of Washington tied to the Biden infrastructure law, as well as eventually the CHIPS Act.
And just points from you on the continued U.S. dollar strength here, Chris, and the pound getting crushed. Where are we going with these currency wars here?
Well, let's talk about the fallout. Consider back in June, we heard Salesforce warn about the dollar. We had Microsoft warn about the dollar. And what's happened to the dollar since then? It has only strengthened. I think that we're going to really see a far greater impact on revenue expectations, earnings expectations, not just for the S&P 500, but for other sectors and other individual stocks as well, because of those renewed dollar concerns and the impact, again, revenue and earnings. But this is just the latest thought. I mean, if we look at the speed of the economy, risks to consumer spending, enterprise spending, I've already been concerned about downward revisions for the second half of the year, and candidly for those in 2023, the dollar headwinds only add to my concern about that.
Well, and to that point, I just want to get back to the S&P. I know you hate making forecasts, but is the bottom in? Because a lot of folks are looking at their portfolio thinking, this is just absolutely awful here. Could we go lower?
Yeah, so my technical partner Bob Lang over at AAP, he's closely watching the 3,400 level. And from a fundamental perspective, my concern is, look, we can guesstimate as to what that P in PE should be, but the real question is, what's the E going to be, and the multiple that we want to really be thinking about. Is it 15, 16 times with the 2-year where it is? Perhaps. But the bigger question is, where does that E settle out? And I don't think we're going to have a good knowledge and base for that until we get through the September quarter earnings season.
I want to talk about what Chris Versace is watching now. I know offline you're telling me PCE, China data, all up on deck. What's the main focus for you?
Well, I mean, if we're talking about the Fed, without a doubt, it's going to be the PCE that is their preferred inflation metric. And if it comes in, hotter than expected or doesn't decline as much as people are expecting for August, it's going to be renewed concerns about the Fed's path. And then we'll be watching both the November and the December expectations over at the CME Fed Watch tool. China's a great one, but not as concerning about the overall impact of the market. Really, what I want to see there, though, is have we emerged from those lockdowns? What are we seeing in terms of a snapback? And how does that factor into what we're looking for in the back half of the year?
Chris, just a thought on commodities. Why are, certain assets such as gold not rallying under these conditions? Is it just a question of the strength of the US dollar?
I'm not a gold bug, Danny, but I will say that yes, my understanding is that is exactly the case. But there are other commodities that are rallying. Whether it's wheat, corn, soybeans, and others. So it's not exactly a uniform market for that.
All right, take it home for us. Just final thoughts for all our viewers and investors watching, Chris.
Just continue to focus on the fundamentals. Always be forward thinking and triangulate the data. Don't let any one data point hook you up. In terms of names we like, take a look at AMN Healthcare, Costco, Verizon with its 6.7% forward yield, and plenty of others in the infrastructure space.
There you go. Chris, always great speaking with you. Come back soon, okay?
Love to.
All right, Chris Versace over at Tematica Research. And thank you all for watching. We'll have much more coming your way, so be sure to stay tuned to Stansberry Research and the Daniela Cambone Show. And don't forget to sign up at danielacambone.com so you can stay on top of all these great interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.